December 1st, 2008, 7:42 a.m. Eastern Time. The Dow Jones Industrial Average is down 679 points before lunch. CNBC is running red banners. General Motors stock has fallen below $5. Rick Wagoner is in Washington begging Congress for $18 billion. Across the Atlantic, in Munich, a different kind of emergency call is taking place. In a quiet conference room at BMW's headquarters, Norbert Reithofer picks up the line. On the other end, Ian Robertson, BMW's head of sales, just back from the United States. The US is collapsing, Robertson says. But Rolls-Royce, it's not slowing down. There's a pause. Outside the window, Germany is bracing for its own recession. American automakers are hours away from becoming wards of the state. The Treasury is drafting the Troubled Asset Relief Program signed into law on October 3, 2008. Alan Mulally is fighting to keep Ford alive without federal money. Rick Wagoner doesn't know that on March 29, 2009, President Barack Obama will force him to resign. And yet, in Los Angeles, Miami, and New York, Americans are still placing deposits on $300,000 cars. This is the part of the crisis nobody talks about. At the exact moment the American dream was collapsing under mortgage-backed securities and predatory lending, Rolls-Royce was quietly expanding its footprint in the United States. The question isn't why Rolls-Royce survives. It's why Rolls-Royce sells so well in America when America itself keeps breaking. And the answer is darker than horsepower. In Woodcliff Lake, New Jersey, on the 7th floor of BMW of North America's headquarters, internal reports dated January 12, 2009 show something extraordinary. U.S. Rolls-Royce deliveries for 2008, 1,243 vehicles, down from the record-breaking 1,703 in 2007. Yes, but still the largest market in the world. The United States alone accounted for roughly 30% of global Rolls-Royce sales. Detroit was on life support. Rolls-Royce was printing money. That's not an accident. That's design. To understand why, you have to go back to January 19, 1998, 11:03 a.m., London. The boardroom of Vickers plc is tense. On the table is the future of Rolls-Royce motor cars. BMW has been supplying engines and electronics since 1994. Volkswagen, under Ferdinand Piëch, wants the brand desperately. Bids escalate in secret. On May 7, 1998, Volkswagen announces it has acquired Rolls-Royce motor cars for £430 million. But here's the twist buried in legal language. Volkswagen bought the factory in Crewe and the Bentley brand. The Rolls-Royce name itself belonged to Rolls-Royce plc, the aerospace company, and it had licensed the name to BMW for automotive use starting January 1, 2003. It was a corporate knife fight conducted with lawyers instead of guns. BMW ended up with the spirit of ecstasy. Volkswagen ended up with Bentley. By January 2003, Rolls-Royce Motor Cars was reborn under BMW ownership, operating out of a purpose-built facility in Goodwood, West Sussex. But the real battlefield wasn't England. It was America. In 1984, in Detroit, Lee Iacocca stood in front of cameras celebrating Chrysler's recovery from its own government bailout. America loves a comeback story. It loves visible success. It worships scale. And by the late 1990s, Wall Street had rewritten the American psyche. On August 9, 1995, the Dow crossed 4,000 for the first time. By January 14, 2000, it peaked at 11,722.98 during the dot-com bubble. Money was everywhere. Silicon Valley minted millionaires overnight. Hedge fund managers in Greenwich bought $20 million Hamptons estates like toys. Status became oxygen. And Rolls-Royce understood something Detroit never did. Americans don't buy cars. They buy validation. On October 18, 2006, Rolls-Royce launched the Phantom Drophead Coupe at the Detroit Auto Show. In the middle of a city already bleeding manufacturing jobs, they rolled out a $407,000 convertible with teak decking inspired by luxury yachts. The symbolism was brutal. Detroit was building survival machines. Rolls-Royce was building floating palaces. Internal BMW strategy documents from 2007, later referenced in German business press, show a key insight. The US ultra-high net worth population was expanding faster than Europe's. According to Merrill Lynch and Capgemini's World Wealth Report on June 6, 2007, the United States had over 3 million millionaires, more than any country on Earth. Rolls-Royce didn't need volume. It needed insecurity. Psychologists call it status anxiety. Alain de Botton popularized the term in 2004, but American capitalism had operationalized it decades earlier. The fear of being invisible. The terror of looking small in a nation that measures worth in square footage and stock portfolios. When General Motors filed for Chapter 11 bankruptcy on June 1, 2009, its stock, once trading above $40 in 2007, was effectively worthless. Assembly lines in Detroit fell silent. The smell of oil and hot steel evaporated into unemployment lines. But in Beverly Hills, O'Gara Coach Company was taking orders for bespoke Phantoms with starlight headliners, fiber optic constellations installed into the roof, mimicking the night sky on the day the owner was born. That detail matters. Rolls-Royce doesn't sell transportation. It sells immortality. The Goodwood factory doesn't operate like Detroit's River Rouge complex once did under Henry Ford II. There's no frantic stamping press thunder. Instead, there's hushed craftsmanship. Lambswool carpets, hand-stitched leather, the scent of polished wood. Each Phantom requires over 800 hours of labor. Customers can request paint colors matched to lipstick shades or yacht hulls. There are reportedly over 44,000 standard exterior colors. This isn't efficiency. It's theater. In the boardrooms of Wall Street, bonuses rebounded fast after the crash. Goldman Sachs reported $13.4 billion in compensation and benefits for 2009, just a year after the meltdown. On December 31st, 2009, the Dow closed at 10,428.05. Recovered from its March low of 6,547.05. The American elite didn't disappear. They consolidated. Rolls-Royce sales followed the money. In 2011, global deliveries reached 3,538 vehicles. The US remained the largest single market. By 2014, Rolls-Royce hit a record 4,063 cars sold worldwide, with America again leading. While Ford under Alan Mulally was executing the One Ford plan, selling off Jaguar, Land Rover, Volvo to focus on survival, Rolls-Royce was narrowing its focus even further: fewer customers, more money per customer. It's a strategy built on American extremes. Consider the numbers. In 2021, Rolls-Royce sold 5,586 vehicles globally, its highest ever at the time. In 2022, that climbed to 6,021. The United States remained its largest market. The Cullinan SUV, introduced in 2018 with a starting price around $325,000, became a runaway success. An SUV. In a country obsessed with size, there's something almost predatory about the timing. The Cullinan launched into a post-2010 America where inequality was widening. According to Federal Reserve data, by 2019, the top 10% of US households controlled over 70% of total wealth. When the pie gets smaller for most, the slices get absurdly large for a few. Rolls-Royce doesn't fight for middle-class buyers. It hunts in rare air. But here's the darker layer. During the 2008 to 2009 bailout hearings, internal GM documents revealed years of mismanagement, bloated brands, and a refusal to kill failing divisions. The arrogance of scale. The God complex of executives who believed market share was destiny. Rolls-Royce executives operate differently. They embrace scarcity. In a 2016 interview, then CEO Torsten Müller-Utve stated clearly that Rolls-Royce would never pursue volume for its own sake. Production would be capped to protect exclusivity. Artificial limitation creates psychological demand. It's the same logic luxury fashion houses use. But in America, it resonates deeper. The American dream was once about ownership of homes, land, companies. After 2008, for many, that dream fractured. Foreclosures peaked at over 2.8 million filings in 2009, according to RealtyTrack. Against that backdrop, a Rolls-Royce became a rolling monument to survival. Not just wealth, escape. The Cullinan's marketing leaned into it. High driving position, command view, isolation from the outside world, double glazed windows, 100 kilograms of sound insulation. A cabin so quiet engineers reportedly had to artificially introduce a whisper of sound so occupants wouldn't feel disoriented. Total separation. Drive through Los Angeles traffic and you can spot the pattern. Blacked out Cullinans in Calabasas. Phantoms gliding past Rodeo Drive. They are less vehicles than armored declarations. In America, visibility is currency. And here's the smoking gun most viewers never see. On September 15, 2008, Lehman Brothers filed for bankruptcy. The largest in US history, that same month, Rolls-Royce Motor Cars North America did not cancel its expansion plans. Instead, internal dealer communications emphasized targeting resilient client segments, code for hedge fund managers, private equity partners, tech founders. They weren't selling to America, they were selling to the 0.1% who profit from volatility. When markets crash, someone makes money. Short sellers, distressed asset buyers, bankruptcy lawyers. The machine never truly stops, it redistributes. Rolls-Royce aligns itself with the winners of redistribution. Look at Miami after 2020. Pandemic chaos, stimulus checks, PPP loans, crypto surges. By 2021, Miami became a magnet for tech investors fleeing high-tax states. Rolls-Royce dealerships in Florida reported surging demand. In January 2022, the company announced record 2021 results, citing the Americas as a primary growth driver. The pattern repeats. Crisis, consolidation, luxury spike. Behind it all, a quiet factory in Goodwood building fewer than 7,000 cars a year, each one absorbing hours of human labor while Detroit once churned out millions. The dark truth isn't that Rolls-Royce is evil. It's that it mirrors America perfectly. In 1925, when the first Phantom rolled off the line in Springfield, Massachusetts, Rolls-Royce was already catering to industrialists, oil barons, railroad magnates, men who built fortunes during America's Gilded Age, a period Mark Twain described as glittering on the surface and rotten underneath. A century later, the surface is shinier. The rot is more sophisticated. Mary Barra became CEO of General Motors on January 15, 2014, inheriting a company reborn from bankruptcy. GM stock debuted again in November 2010 at $33 per share. It would fluctuate, but the scars remained. Detroit learned humility. Rolls-Royce never had to. Because its customers don't need humility. They need insulation from noise, from criticism, from the fear that their wealth could evaporate like Bear Stearns on March 16, 2008, when JP Morgan agreed to buy it for $2 per share. The ultimate luxury isn't speed, it's immunity. Rolls-Royce sells the illusion of immunity in a country addicted to risk. So what? Next time you see one glide past, ask yourself who had to lose for that car to exist, and who's betting on the next collapse.